Welcome investors to my channel Fiscal Voyage. My name is Felix. In this video, I'm going to provide you guys with a stock analysis of a company that I'm particularly buying right now. But before we get started, if you're new to the channel, make sure to subscribe because in this channel we like to talk about dividend investing, investments, savings ideas and such. So make sure to hit the subscribe button if you're new to the channel. The company that I'm going to be discussing in this video is Bristol-Myers Squibb, which has a projected earnings growth of 32% for 2020 and 2021 expected earnings growth of 19%. So the growth story is there. So make sure to watch towards the end of the video because I'm going to provide you with a fair value price as well as my recommendation to determine if it's a buy, sell, or hold at current prices. Okay, the stock analysis on Bristol-Myers Squibb Company, ticker symbol BMY. The company is a pharmaceutical company headquartered in New York City, manufacture prescription pharmaceuticals and biologics in several therapeutic areas such as cancer, HIV/AIDS, cardiovascular diseases, diabetes, hepatitis, and a lot more. So let's look at the fundamentals from the company. Revenue only grew at 3.3% from 2010 to 2019 in this 10-year period. Net income only grew at a slightly lower rate at 1.2% from that 10-year period as well. Credit rating is A+, which is good, and operating income at a 10-year period at 0.5%. And earnings per share growth was 9%. So you may be asking, Felix, why are you investing in this company that's been growing revenue at only 3.3% for the 10 years and 1.2% for net income in that 10-year period? Well, this is why. Earnings for the past 5 years has been growing at a rate of 23.6%, net income in that 5-year average of 21.8%, and revenue at 12.1%. So the company overall 10 years has been very lackluster, but the past 5 years has been doing outstanding. And future growth, as we see in a few slides, is going to be tremendous. So let's continue here. For last year fundamentals, 2019 company earned $4.69. Net margin came in at 13.2%, which was lower, however, versus 2018, which was 21.8%. But it's more or less in the average range between 13 and 20%. So that's okay there. Return on equity at 10.5%, which is slightly lower than their 5-year average. Current dividend yield at a nice 3.15%, which is not tremendous yield, but is a nice respectable yield. However, the 5-year growth rate is only 2.5%, so that's very low. This is actually below the rate of inflation of 3% or so. That gives us a charter rule of 5.65, which is much lower than my recommended or suggested criteria of 11 or higher. But if we look further in the future outlook, this may be interesting because the company increased the dividend by 9.8% in December. So this is almost 4 times higher than their average 5 years of 2.5. So that's great because expected earnings, as we see in a few slides from now, is going to be much more higher. So this gives the company more chance of growing dividends at a better rate. And the dividend payout ratio is only 29.1%, which means the dividend is very safe, and it gives the company plenty room to continue growing dividends at a better rate, 5% to 10%. And they've been growing dividends for 11 consecutive years. And the 5-year dividend yield average of 2.73 is much lower than the current yield, 3.15. So that's a good indicator that the company may be undervalued based on dividend. So let's continue with the balance sheet, which is pretty good actually. The debt to cap is only 44%, which is solid there. The current ratio of 1.66, which is better than the considered ratio of 1.5. So that's good there, which is asset divided by liability. So we have more asset than liability ratio there. Debt to equity is below 1 at 0.95, so that's good. And the price to book ratio came in at 2.59, which is much lower than the 5-year average of 6.45. So that's a good indicator there that it's undervalued based on price to book. And you would like to see price to book of a ratio of 3 and under, and that's beats that criteria here. Future outlook. So this is where this company becomes exciting. For 2020, analysts expects earnings to be at $6.20. This is much better than the 2019 earnings of $4.69. And the earnings expectation for 2020 hasn't dropped significantly because of the economic shutdown. So that's very solid here. And 2021, they're expected to make even more at $7.39. And analysts has been right almost 100% of the time, or the company beat estimates. So I'm very confident that the company is going to make these earnings. And CFRA has a projected earnings growth of 12%. And using my dividend yield return model, total projected return came in at 16.4%. That's outstanding. I like to see it at 9%, 10% or higher. We're getting 16.4% rate of return based on 2020 expected earnings. And if we look at the current PE and the forward PE, currently the company has a PE of 10.6, which is based on the 2019 earnings, and a forward PE of 9.2 based on the 2020 expected earnings. So that's a good indicator there that the earnings are expected to be better than last year. And the 5-year average is 18.2. So this is much lower current PE versus their 5-year average. So this is a very good indicator that it may be undervalued. So let's look at the fast graph. The black line is the monthly closing price. The orange is the earnings with a multiple of 15, and the blue is normal PE of 22. And as you can see, between 2013 and 2016, the company had a high valuation of looks like around 25 or so, and then it dropped. It was basically flat. The price has been very flat for the past 7 years, 8 years. And you can see, however, earnings has been growing and been growing substantially. In 2016, earnings grew at 41%, and in 2018, 32%, and in last year, 18%. And for this year, analysts are expecting earnings to grow at 32%, and in 2021, 19%, and 2022, 7%. So this is the reason why I'm buying this company, because based on 2020 and 2021 earnings, it looks to be very undervalued. As you can see, if the price meets the 15 multiple for 2022, we have an expected annual rate of return of about 35.6% annually. And basically in 3 years, we possibly have a total return of 116%. So that'll be a whole run stock in almost 2 years. So that's great here. And as you can see here, the blended adjusted earning yield of 9.43, which is much better than the 6 or so earning yield criteria that I like to have. So there's a lot of potential here with BMY. So this is one of the reasons why I'm buying a lot of shares of this particular company right now. And if we look at the fair price, CFRA has a fair price of $48.67. Morningstar is 68. Fast Graph, as we just saw, which is 92.99. This is based on 2021 expected earnings. So just FYI, and that's with a multiple of 15. Yahoo came in at 71.91 cents, and my dividend discount model analysis came at 64.20 cents. For my analysis, I used 7% dividend growth for the next 3 years and 7% after that with a discount rate of 10%. I think the company is going to be growing dividend at a much better rate because earnings is going to be growing much higher rate. So that's why I'm using a 7%, a little conservative there versus their recent increase, which was 9%. So that's why I'm using 7%. And averaging out the 5, we get a fair price of $69.15. And currently, the company goes for $57.08, meaning that the company is undervalued by 21%. So this undervaluation meets my criteria of 10% margin of safety and more. And that's why I have a buy recommendation for BMY. So as you just saw, I have a buy recommendation for BMY. The past 10 years hasn't been that great. The price actually been flat, and the revenue and net income growth, as you just saw, was flat as well, of 3% to 1% for net income. However, the company for the past few years has been in an acquisition phase, and that is now turning around. As I mentioned, 2020 earnings is expected to be 32% higher than 2019 earnings, and then 2021 earnings expected to be 19% higher than 2020 earnings. So that's tremendous growth for already a big company. And my dividend dual return model came in at 16.4% annual rate of return. So that's great compared to my minimum criteria of 9% or higher. The forward PE of 9 versus the 5-year average of 18 describes tremendous undervaluation to its normal PE ratio. Best part for the company right now is the 21% undervaluation based on its fair price estimates. So we have a margin of safety of 21% to its fair value price. I've been adding shares myself personally in my dividend growth portfolio. So I think this is a stock that you guys should look into and further research, because I think it has a lot of potential to grow your portfolio. So, but before you buy shares, make sure to do your own evaluation and make your decision on your own. Again, if this is the first time visiting my channel, make sure to hit the subscribe button, and I'll see you guys tomorrow in the next video.